Crocs Inc. ticker symbol CROX is currently trading at $133.75 a share. This stock is up almost 42% from the start of the year. What we're going to be doing is looking at the company's financials and seeing if it is a buy or a sell using the discount free cash flow model, comparable company model, and the Ben Graham formula for intrinsic value. So as I said, this stock has been on a bit of a tear the last year, up 42%. Over the last year, which takes us back to October 23, it is up 55%, but down from its all-time highs of $160 a share. If we go to the max chart, you can see that, I lied, sorry, it's not at all-time highs. All-time highs are 180, that was back in 2021. The stock dropped 70% and has then gone on a pretty bullish run. So let's have a look at my automated stock valuation spreadsheet. If we put in the ticker CROX, CROX, this will load all the latest company financial data, and then we can have a deeper dive and see if it is a buy or a sell. So market cap 8 billion, P ratio of 10. Wow, that is very, very low. Market average is around about 29, so that is much lower than the market average. Earnings per share, $13.30, a beta of 1.99, meaning there's a lot more volatile than the market, and a target price, analysts are saying it is a buy at $162 a share. Now, let's have a look at the revenues. This is revenues going back to 2011, and in the trailing 12 months, all-time highs, $3.94 billion, beating out, well, every other year, as I said, all-time highs. They had a big jump up in 2021, a big jump in 2022, and then has increased slowly, but still positive growth, which is what we want to see. Net income, $810 million, or 0.81 billion. All-time highs again, 0.79 to the prior year. They had a big jump in 21, which obviously if we compare to the profits, the revenues, you can see that, and they are still very profitable. Are they generating free cash flow? Yes, they are. 0.88 billion, all-time highs once again. Now, if we have a look at the operating cash flow versus capex, you can see operating cash flow is up and up and up. Capex has increased, but is actually down slightly from 2023, which is why we have these lovely bit of free cash flow right there. Shares outstanding, they are buying back their shares. You can see here they've consistently bought them back, although they have increased slightly in some instances, but the general trend is they are rewarding shareholders by buying back their shares. So let's have a look at the discounted free cash flow model. This is a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. This is based on the averages, and currently this gives a calculated stock price of $155 a share, meaning it's at a 16% discount. As you can see here, the free cash flow rate of the current, or free cash flow ratio, is about 15, so that is quite nice. Average free cash flow of the last 5 years, 35. So let's have a look at these numbers and see if we can we'll tweak them and see what we can see. So we're expecting about 4.6 and 5.4 billion in the coming years. Let's see if analysts agree or disagree with those. We're a little bit more bullish, actually, 4.1 and 4.3. Even on the high sides, we are still a bit more bullish. So over the next 5 years, they are expecting pretty good growth at around about 8%. So it is quite interesting that we're a little bit more bullish than that. So fine, we will bring this down. We'll take an average of the last few years. This is about 7%, drops it down quite a bit, brings it to $109 a share. Net income margins, I'm pretty happy with that, actually, around about 20%. And yeah, net income free cash flow, we're expecting a lot higher number. I mean, currently with the last year at 107%, puts it $230 a share. So if we just take an average of them, that puts us at around about 86. $185 a share. So that is with more conservative revenue numbers, as we've seen, but then average free cash flow rate, a much more sort of a valid year of the 23 and 24. So even if we take an average of the last 3, brings it down a bit to 71, I think this will still be at a buy at $150 a share. So somewhere in the region of $150 to $180 a share. Well, before we look at the comparable company model, I'm just going to look at the Ben Graham model. But yeah, please like and subscribe if you haven't already, and check my Patreon if you're interested in the sheet. So this is the Ben Graham formula for intrinsic value. It's a way of valuing stocks, which was designed by the, godfather of value investing himself, Ben Graham. Looks at the earnings per share of the company, P of no growth companies, AAA bond yield, and the current AAA corporate bond yield, which is around about 4.68%. Now, unfortunately, I think we did see that it was around about 8% growth, I believe, over the next, annualized, according to analysts. Yeah, 7.55%. We will plug this into the sheet. And it is a buy. Fair value of $200 a share and a grain price, which is a discounted price, what you know, with a certain margin of safety, $150 a share, and obviously the price is currently $133. So discounted free cash flow really likes the stock, and Ben Graham formula for intrinsic value really likes the stock. So we'll head on to the final model, which is the comparable company model. And this is a way of valuing companies looking at similar companies of similar sizes, metrics, revenue, net income. We look at profit margins, price to sales, price to book, PEG, and then the metrics here, EV to revenue, EV to EBITDA, PE, and forward PE. So some companies that I want to compare it to, immediately I do want to compare it to Nike. Let me just get the ticker up. I believe it's NKE, but I just want to be sure. Yep, NKE, obviously a lot bigger than Crocs, but you know, a similar-ish company. I've got CROX on my other screen here, which obviously you guys can't see, but another one I would say is Skechers, which is SKX. And once again, this will load up all the company financial data for all these as well. And according to this, ticker symbol SHOE, which is Stephen Madden Limited. This is a footwear company as well. And I don't know too much about these, but I did see this on Seeking Alpha, and it is a sort of similar-ish size company. So obviously quite varying a little bit here. We have less than 10 billion on Crocs and Skechers. Nike, obviously much bigger, 120 billion. Steve Madden at 3.3. Revenue growth rate, Crocs is the highest, 28%. Only Skechers comes close with 11%. Profit margins, highest profit margins out of all of them, higher than Nike, higher than Skechers, higher than Stephen Madden, 20%, so that's excellent to see. Price to sales, the current average of the market is about 3, so all of these companies are lower than the market average. Price to book, 5.1, lower with 4.8, only Nike is higher. Now PEG, actually, price to earnings growth, this comes from my source, well, the place where I get this from, and it is -31, which is interesting. I don't believe that's right. So let me just see if I can find out Crocs PEG ratio from another source. And well, Google AIs tell me 1.4 price to earning growth rate. Yeah, 1.3. So is probably one of the lowest, a little bit higher than Skechers, lower than Stephen Madden, definitely lower than Nike. It's interesting it has returned that, but definitely on the lower side. Still not less than 1, which is what Peter Lynch would normally look for. So then we have the metrics here, EV to revenue, EV to EBITDA, PE, and forward PE. In terms of PE, I don't know why these colors have gone this way. EV to revenue, it likes it the least, it is the highest one, but EV to EBITDA, $206, PE $220, forward PE $216, brings the average of actually $173 a share. So Ben Graham likes the stock, comparable company likes the stock, and discounted free cash flow likes the stock, and they're all pretty close. 185, give or take. Dividend discount model we're not looking at. $200 a share. And finally, an average of all these at around about 173, and this is obviously with the EV to revenue bringing down the averages. Otherwise, it would be around about 200. So it does look, well, all the models do seem to think it is a buy. So that's quite interesting. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe, check my Patreon, all that fun stuff, and I will catch you guys next time.